For decades, Mint, the US dollar has been the backbone of global finance, the world's trusted reserve currency, and the foundation upon which international trade has operated. But recently, something dramatic has been happening. More and more countries, central banks, and even individual investors are quietly moving away from the dollar and into one asset that has stood the test of time: gold. Investment. This shift signals a deeper crisis that could reshape the financial system as we know it. The first point to understand is that trust in the dollar is beginning to weaken. For years, the United States has been running high levels of debt, printing money to stimulate growth, and relying on its status as the world's financial leader to maintain credibility. But with inflation eating away at purchasing power, rising interest rates making debt more expensive, and geopolitical tensions straining alliances, many countries are asking a simple question: why should the dollar remain the world's safe haven? When trust begins to erode, even slightly, the consequences ripple across the globe. This brings us to the next major trend: the flight to gold. Investment. Unlike paper currencies, gold doesn't depend on the promises of governments or central banks. It has survived wars, financial collapses, and centuries of uncertainty. Right now, investment. Central banks from China to Russia to even smaller emerging economies are stacking up gold reserves at the fastest pace in decades. For them, it's not just about diversification, it's about security. Gold acts as a shield against the risks of holding too many dollars in a world where the value of the dollar feels less guaranteed. But what does this mean for global trade and investments? If the dollar continues to lose dominance, international trade could shift toward a multipolar system where multiple currencies compete for influence. That could make transactions more complicated, investment, borrowing more expensive, and financial markets more volatile. For investors, it means assets tied directly to the dollar could face stronger headwinds. Good investment. While commodities like gold may benefit from a rising wave of demand, this shift doesn't happen overnight, but we're already seeing the early signs play out across markets. Investment. And here's where it gets personal. What can individuals do to protect their wealth in a world where the dollar's dominance is fading? The answer lies in preparation, not panic. Investment diversification has never been more important. Holding a portion of assets in hard commodities like gold can help balance out risks from a weakening dollar. Being mindful of inflation, investing in real assets, and building a portfolio that isn't overly exposed to just one currency or market are key strategies that can help weather the storm. The dollar crisis is more than just a headline. It's a signal of change. The world is dumping dollars and buying gold, and whether you're a policymaker or an everyday investor, ignoring this shift could be costly. The smartest approach is to recognize what's happening, adapt accordingly, and focus on strategies that preserve wealth not just for today, but for the long term. The story of the dollar's declining trust begins with the very foundations of the global economy. For decades, the US dollar has been viewed as the ultimate safe haven currency, the one asset that governments, central banks, and investors could rely on when everything else felt uncertain. But the stability of a currency is ultimately built on confidence. And once that confidence begins to erode, the decline can be subtle at first, then accelerate rapidly. Over the past several years, signs have been emerging that the dollar is not as untouchable as it once was. This erosion of trust is not the result of any single event, but rather the culmination of multiple forces: economic, political, investment, and structural, that have all chipped away at the dollar's once unshakable dominance. One of the key drivers of this decline is the sheer amount of debt the United States carries. Investment. The federal government has accumulated trillions of dollars in debt, and each year that number continues to rise. To put it simply, a country's currency is only as strong as the belief that it can manage its finances responsibly. When investors and foreign governments see ballooning deficits and an inability to rein in spending, best they begin to worry about the long-term value of the dollar. This is compounded by the fact that the US has leaned heavily on money printing in times of crisis, meant from the financial crash of 2008 to the massive stimulus measures during the pandemic. While these moves were designed to stabilize the economy in the short run, they came with the long-term cost of inflationary pressure and reduced confidence in the dollar's ability to hold value. Inflation, in particular, has been one of the most visible signals of this weakening trust. When everyday Americans find that their money doesn't buy as much as it used to, that sentiment reverberates across the globe. Other nations holding large reserves of dollars notice it as well. Inflation is, at its core, a tax on savings. If the US can't keep its currency stable, then the incentive for other countries to continue relying on it as their primary reserve diminishes. Even though the US has taken steps like raising interest rates to combat inflation, the damage to confidence has already been done. The credibility of the dollar is no longer unquestioned, and that shift in perception is a dangerous one. Another layer to this decline is geopolitical tension. The United States has historically leveraged the dollar's dominance as a tool of influence, using sanctions and restrictions to advance its political goals. While this strategy may serve U.S. interests in the short term, it creates strong motivation for other nations to reduce their dependence on the dollar. Countries like Russia and China, for instance, have been actively seeking alternatives, forming trade agreements that bypass the dollar entirely. When large economies start to move in this direction, it signals to others that relying too heavily on the dollar is a risk. The weaponization of the currency may have accelerated the very decline in trust that the US has been trying to avoid. At the same time, the rise of emerging markets and the diversification of global trade are creating a natural shift away from dollar dominance. As countries strengthen their own currencies and pursue bilateral trade agreements, the necessity of always transacting in dollars is being questioned. While the dollar remains the most liquid and widely used currency, it no longer enjoys the same unquestioned monopoly it once did. Investment. The growing interest in alternative systems, including digital currencies and regional trade blocs, only underscores how fragile the dollar's dominance may become in the years ahead. For investors and ordinary citizens alike, this decline in trust has real implications. It doesn't mean the dollar is collapsing tomorrow, but it does mean that the unquestioned faith that once surrounded it is fading. Currencies thrive on belief, and once cracks begin to form, they can widen quickly. History has shown that no reserve currency lasts forever. The British pound once held the position that the dollar does today, but after decades of war, debt, and economic strain, it eventually ceded its role. The same forces are now starting to play out with the US dollar, and the signs are becoming harder to ignore. ChatGPT said, "Throughout history, whenever uncertainty in the financial system has risen, gold has consistently reemerged as the ultimate safe haven." The shift toward gold that we're witnessing today is not just a passing trend, but a strong signal of how investors and entire nations perceive the risk associated with paper currencies, particularly the US dollar. Unlike fiat money, which depends on government promises and central bank policies, gold has intrinsic value, scarcity, and a universal acceptance that transcends borders. The recent surge in central bank purchases and the rising global demand for gold reflect a deeper concern the dollar may no longer provide the same level of security it once did, and in times of doubt, meant people return to what has always stood the test of time. The most striking evidence of this shift can be seen in the actions of central banks. In the past decade, countries around the world, particularly those with strained relationships with the United States, have been stockpiling gold at record levels. China, Russia, and even smaller economies have made gold accumulation a strategic priority. Investment. This is not simply about diversifying portfolios, it's about building financial independence. By holding more gold, these countries reduce their reliance on the dollar, shield themselves from sanctions, investment, and protect their reserves from the risks of U.S. monetary policy. Investment. The fact that this movement is not limited to a few nations, but is instead a global trend speaks volumes about the changing perception of gold as the bedrock of financial security. One reason for this pivot toward gold is the growing recognition that it serves as a hedge against inflation. While fiat currencies can be devalued with a printing press, gold cannot be created out of thin air. Its supply grows at only about 1% to 2% a year, making it one of the rarest and most stable assets in existence. During periods when inflation erodes the purchasing power of paper money, investment, gold tends to hold or even increase its value, preserving wealth for those who own it. The recent inflationary surge has reminded investors of this reality, prompting both institutional and retail buyers to allocate a larger share of their assets into gold. When the cost of living rises and wages fail to keep pace, gold becomes a form of insurance that protects long-term savings from being eaten away. Beyond inflation, gold also shines during times of geopolitical instability. Wars, sanctions, trade conflicts, and political uncertainty all increase the appetite for safe assets, and gold has no rival in this regard. Unlike bonds or equities, which are tied to specific economies, gold is stateless. It is universally recognized and easily stored and highly liquid. For nations worried about the risk of having their reserves frozen due to sanctions or financial disputes, gold offers a level of autonomy and protection that the dollar simply cannot provide. This explains why countries facing strained relations with the West are among the largest buyers of gold today. For them, gold isn't just an investment, it's a tool of sovereignty. Investors are also waking up to this shift. The growing popularity of gold exchange traded funds, the rising demand for physical bullion, and the strong performance of gold in times of market turbulence show that individuals are taking cues from central banks. Many see gold not as a way to make quick profits, but as a means of preserving purchasing power in an environment where currencies, stocks, and bonds all carry heightened risks. In a diversified portfolio, gold provides balance, offering stability when other assets falter. Its role is less about growth and more about protection, and in today's uncertain climate, that role has never been more important. Investment. The return to gold is not merely nostalgia for an ancient store of value. It's a rational response to the vulnerabilities of the current financial system. In a world where the dollar's dominance is being questioned, where inflation is eroding trust in paper money, and where geopolitical risks are multiplying, gold offers something no fiat currency can match: permanence. It is the asset people turn to when they want certainty, when they need security, and when they can no longer place complete faith in promises made by governments. The fact that this shift is accelerating should be taken as a clear signal that gold is once again reclaiming its role at the center of global finance. The weakening trust in the dollar and the simultaneous shift toward gold is not just a story about currencies and commodities. It has profound implications for global trade and investments. For decades, the dollar has acted as the universal medium of exchange, the common denominator that allowed international trade to flow smoothly. All commodities, investment, and countless goods have been priced and settled in dollars, which simplified transactions and reduced risk for businesses and governments alike. But as more countries move away from the dollar investment, the landscape of global trade becomes increasingly complex. And that complexity carries consequences for investments, economic growth, and financial stability worldwide. One of the most immediate effects is the potential fragmentation of trade settlements. If nations no longer rely primarily on the dollar, they must seek alternative arrangements, and such as bilateral agreements in their own currencies, or even barter, like systems where goods are exchanged directly. This trend has already begun. Investment with countries like China and Russia entering agreements to trade in yuan and rubles rather than dollars. While these moves reduce their dependence on the dollar, they also introduce new risks. Currency volatility becomes a larger factor, and businesses face increased uncertainty in pricing, hedging, and long-term planning. For investors, this fragmentation could lead to more volatile markets, as global commerce loses the stabilizing anchor that the dollar once provided. Another impact is on debt markets. For years, emerging economies have borrowed heavily in dollars, taking advantage of lower interest rates and the dollar's liquidity. But as trust in the dollar fades and as U.S. interest rates rise, the cost of servicing dollar-denominated debt becomes a heavier burden. Countries that rely on these loans face potential repayment crises, leading to defaults or financial instability. This ripple effect doesn't stay confined to those nations. It spreads across global markets, shaking investor confidence and triggering capital flight. On the flip side, as gold and other currencies gain prominence, new lending frameworks may emerge, but they will take time to establish and may lack the efficiency and scale of dollar-based systems. For investors, this creates a world of heightened credit risk, where traditional assumptions about sovereign debt safety no longer apply. Trade imbalances also take on a new dimension in a world with reduced dollar dominance. The United States has long benefited from what economists call the exorbitant privilege of issuing the world's reserve currency. It could run persistent trade deficits without the same consequences other nations might face, because there was always global demand for dollars. If that demand weakens, the U.S. may be forced to adjust by importing less, exporting more, or facing inflationary pressures from a declining currency. That shift could reshape global supply chains, as countries that once catered heavily to U.S. Everything may diversify their trading partners. For investors, this means that industries tied to US consumption may see long-term headwinds, while those positioned to serve emerging markets could benefit from the rebalancing. In addition, commodities markets will feel the effects of a reduced dollar role. Oil, gold, and agricultural goods have long been priced in dollars, but as more nations push to transact in alternative currencies or through direct commodity exchanges, pricing mechanisms may become more fragmented. This fragmentation can increase volatility in commodity prices, making it harder for producers and consumers to plan ahead. For investors, the implication is clear. Exposure to commodities could become riskier in the short term, but potentially more rewarding for those who can anticipate regional shifts in demand and supply. And the diversification of pricing currencies may also create arbitrage opportunities, but it will require sharper analysis and greater attention to geopolitical dynamics. Investment. Perhaps the most significant long-term impact is the reconfiguration of global capital flows. For decades, global savings, particularly from emerging markets, have flowed into US assets like treasury bonds because they were seen as the safest place to store wealth. But if the dollar's dominance fades, that flow could redirect toward other currencies, regions, and asset classes. Europe, Asia, and even digital assets could attract larger portions of global capital. That would change the dynamics of interest rates, equity valuations, and even real estate markets. For the US, it could mean higher borrowing costs and less foreign support for its financial markets, while for other regions, it could mean new inflows of investment and opportunities for growth. Investment. The impact of the dollar's decline on global trade and investments is far-reaching and multifaceted. It introduces more volatility, reshapes debt markets, alters supply chains, fragments commodity pricing, Everything redirects capital flows. While the transition away from dollar dominance will not happen overnight, the early signs are already visible, and the consequences are beginning to ripple through markets. Investors, businesses, and policymakers alike must recognize that the world of tomorrow will not be as dollar-centric as the world of yesterday. Those who adapt early will be best positioned to navigate the turbulence ahead. In an environment where the dollar's dominance is weakening, inflation is eroding purchasing power, and global markets are shifting toward alternative stores of value like gold, individuals are faced with an important question. How can they protect their wealth in uncertain times? While governments and central banks have the ability to reshape policies and create large-scale strategies, ordinary people must take a more practical and personal approach. The good news is that history offers valuable lessons, and with careful planning and disciplined decision-making, individuals can build financial resilience even in periods of global instability. The first and most fundamental strategy is diversification. Relying too heavily on any single asset class, currency, or market creates vulnerability. In the past, many investors assumed that holding cash or dollar-denominated assets was the safest strategy, but the recent decline in trust in the dollar highlights the risk of overconcentration. Diversification means spreading investments across different asset classes, such as equities, bonds, real estate, commodities, and precious metals like gold. Each of these reacts differently to economic conditions, and while some may struggle during inflation or currency weakness, others may thrive. By holding a balanced mix, individuals reduce the risk of losing too much value when one area falters. Gold, in particular, has reemerged as a vital tool for protecting wealth. Allocating even a small percentage of a portfolio to gold can act as an insurance policy. It is not about trying to predict short-term price spikes, but about preserving purchasing power over the long term. When paper currencies weaken, gold often rises, helping to balance out the erosion in value elsewhere. For individuals who may not want to deal with physical gold storage, there are also gold-backed exchange-traded funds or digital platforms that allow safe and convenient ownership. The key is to treat gold as a hedge, not a speculative bet. Another way individuals can safeguard wealth is by prioritizing investments in real assets. Real estate, farmland, and infrastructure-related investments tend to hold intrinsic value and often perform well during inflationary periods. Unlike paper assets, they are tied to tangible utility and demand. Real estate, for example, can generate rental income while also appreciating over time. While property markets carry their own risks, owning real assets provides protection against the erosion of currency value because people will always need housing, food, and basic services regardless of financial system shifts. Beyond asset allocation, individuals should focus on building financial flexibility. This includes maintaining emergency savings in stable forms, reducing unnecessary debt, and keeping expenses under control. High interest debt is particularly dangerous in uncertain economic times, as rising rates can quickly turn manageable obligations into overwhelming burdens. By paying down liabilities and strengthening cash flow, individuals give themselves more room to maneuver when economic shocks occur. Liquidity is another crucial element. Having access to cash or liquid investments ensures that opportunities can be seized when markets overreact or when personal needs suddenly arise. Investment. It is also important to pay attention to global trends and be willing to adapt. In a world where trade patterns are shifting and currencies beyond the dollar are gaining influence, individuals may benefit from exposure to international investments. Holding assets denominated in other strong or emerging currencies can act as a hedge against dollar weakness. Similarly, investing in global companies, investment, technology, and industries positioned to grow regardless of U.S. policy provides another layer of protection. This approach reduces the risk of being overly dependent on the fortunes of a single economy. Lastly, education and discipline play a crucial role. The financial environment today is filled with noise, speculation, and short-term hype. Investment. Protecting wealth requires avoiding reactionary decisions and focusing on long-term strategies. Individuals who educate themselves about financial markets, understand the risks of overexposure to any single asset, and stick to well-thought-out plans are far more likely to succeed. Emotional decisions, panic selling during downturns, or chasing quick gains during rallies are among the fastest ways to destroy wealth. By maintaining a clear strategy and reviewing it periodically, individuals can adjust thoughtfully to changes without being swept away by fear or greed. In the end, investment, wealth protection in times of uncertainty comes down to preparation rather than prediction. No one can perfectly forecast when the dollar will lose more ground, how long inflation will persist, or when geopolitical tensions will escalate. But by diversifying across assets, including safe havens like gold, investing in real assets, strengthening personal finances, exploring global opportunities, investment, and maintaining discipline, individuals can safeguard what they've built. The goal is not to eliminate risk entirely. That's impossible, but to build resilience so that whatever happens in the global economy, wealth is preserved and opportunities remain within reach.